Module overview. Adjusting entries is a critical part of the accounting cycle that ensures revenues and expenses are recognized in the correct accounting period according to the accrual basis of accounting. They are made at the end of an accounting period before preparing financial statements to update account balances that have not yet been recorded through regular transactions. This module explores the types of adjusting entries, their purposes, and how they affect the financial statements, ensuring accuracy and compliance with accounting principles. Why adjusting entries are necessary. To match revenues and expenses in the period in which they are earned or incurred, following the matching principle. To ensure financial statements accurately reflect the company's financial position and performance. To recognize revenues that have been earned but not yet recorded, and expenses incurred but not yet recorded at period end. To update asset and liability accounts related to prepaid expenses, accrued expenses, unearned revenues, and accrued revenues. Types of adjusting entries. 1. Prepaid expenses payments made in advance for expenses, recorded initially as assets. Adjustment needed to expense the portion used during the period. Example, prepaid rent, insurance, supplies. Journal entry, debit expense account credit. Prepaid expense, asset account. Section 2, Types of adjusting entries 2.1. Prepaid expenses payments made in advance for expenses, recorded initially as assets. Adjustment needed to expense the portion used during the period. Example, prepaid rent, insurance, supplies. Journal entry, debit expense account, credit prepaid expense, asset account. 2.2 Unearned revenues, cash received before earning the revenue, initially recorded as a liability. Adjustment recognizes the portion of revenue earned during the period. Journal entry, debit unearned revenue, liability. Credit revenue account 2.3. Accrued revenues earned but not yet recorded or received in cash. Example, services provided but not yet billed. Journal entry, debit accounts. Receivable credit revenue, 2.4 Accrued expenses. Expenses incurred but not yet paid or recorded. Examples, salaries, interest, utilities payable. Journal entry, debit expense credit accounts, payable or accrued liabilities. 2.5 Depreciation expense allocation of the cost of a fixed asset over its useful life. Recognized periodically as depreciation expense. Journal entry, debit depreciation expense. Credit accumulated depreciation contra asset. Section 3. How adjusting entries affect financial statements. Balance sheet. Updates asset and liability accounts to their correct balances at period end. Income statement. Ensures revenues and expenses are recorded in the correct period, providing accurate net income figures. Without adjustments, financial statements can be misleading or incomplete. Section 4. The adjusting process. Usually done at the end of the accounting period, monthly, quarterly, or annually. Requires careful analysis of unrecorded economic events. Adjusting entries are journalized and posted to the ledger accounts, followed by preparing the adjusted trial balance, which reflects updated account balances. Section 5. Examples of adjusting entries. Example 1. Prepaid insurance adjustment. Prepaid insurance of $120,000 was paid for 12 months starting January 1st. By March 31st, 3 months have expired. Adjustment. Insurance expense. N30,000, 3 to 12, x 120,000. Prepaid insurance, N30,000. Example 2. Accrued salaries employees earned N50,000 in salaries by March 31st but will be paid next month. Adjustment. Salaries expense, N50,000. Salaries payable, N50,000. Section 6. Summary. Adjusting entries are indispensable for maintaining the integrity of financial reports. They bridge the gap between cash transactions and economic events, ensuring compliance with the accrual basis and accounting principles such as matching and revenue recognition. Mastery of adjusting entries leads to more accurate financial statements and informed decision-making.